Hi CA students, let's revise CFA and AFM Chapter 6 Portfolio Management. Practical question 35. Ramesh wants to invest in stock market. He has got the following information about individual securities. A to F securities are given, expected return is given, and beta is given. Along with that, unsystematic risk is given. Now market index variance is 10% and the risk-free rate of return is 7%. What should be the optimum portfolio assuming no short sales? So here they are asking what is the optimum portfolio. So we have to calculate the Sharpe's optimum portfolio using the following steps as laid down here. So Sharpe's optimum portfolio, it basically gives us the idea of selecting the mix of risk-free and risky assets that maximizes the excess return that is earned through the beta or the sensitivity towards market return. So it's especially useful for constructing portfolios that offer the best trade-off between risk and return. For a given risk appetite, like how much a person is willing to bear the risk. Will not get much into the technicality of this problem. ICAI has given a set of steps to be followed to calculate the optimum portfolio, and the formulas are little complex. So if you guys want a separate video on this, I will upload it later on. So please comment in the comment section. As of now, I am proceeding with the given solution. So I have laid down the steps to be followed to solve this problem. But the idea is what I've explained. It is the combination of risk-free assets and risky assets in a certain proportion, wherein it will give the optimum portfolio. But this portfolio is considered based on the risk appetite of the investor, which is nothing but how much he will take the risk in both fronts, like the unsystematic portion also. That's the basic idea. Now for this, first we have to find out the trainers ratio of each and every stock in the portfolio. Now once the trainers ratio is found out, then we have to rank them, like which is trainers ratio, as we have discussed in previous videos, is nothing but the excess return which we are getting over the beta, or which we are getting over the sensitivity of the stock towards the market return. Now so we have to rank them accordingly. Once after we rank them, we have to calculate the cutoff for all the stocks. Like before calculating the cutoff, we have to take the CI, which is nothing but the same cutoff point, but based on this CI for all the stocks, then the highest CI we will be considering as the cutoff. So for CI, for calculating CI, I is given one formula. I'll give the explanation later on in a separate video. Once after substituting in this formula and arriving at this cutoff point, the highest CI will be the cutoff point. Then we have to compare this cutoff point with the trainers ratio. Wherever the excess return which we got towards the beta, that more than this cutoff point has to be selected for the optimum portfolio, and less than this cutoff point, whatever this trainers ratio is there, we have to directly eliminate. Will not be including it in our portfolio because that will not meet our risk appetite. That's the basic idea. Now once after selecting the stocks, let's say if only one stock is there, then we'll be investing 100% in that stock. If more than one stock is there, then we have to calculate some proportion. that proportion also will not be directly doing it by some weighted average or something. For that also we have some specific formula. So using this formula we'll be finding out the proportion that has to be invested, and once the proportion is found out, then we will be using the weighted average using this proportion. So for a better example of using this proportion I'm given here, let's say if two stocks A and B is there, once we apply in this formula we'll get one percentage. Then for A, like for ZA ZB, like that we will be getting different values. Adding all those values will be the total, and then the individual values divided by the total will give us the proportion. So that will be the proportion, not what we got in this formula. So in that promotion we have to invest to get the optimal portfolio. Okay, now this is the procedural. Now going to the actual problem. Now as we have the securities and then the expected return beta and unsystematic risk, we have to calculate first trainer's ratio, which is simple, that the expected return minus the risk-free return, which is 7% in our case, divided by the beta of the respective stock will give us the trainer's ratio. So in our case, as we can see, for A to F we have the trainer's ratio, and based on that I have arranged in the order. 5.33 is the first rank, then 4.67 is the second rank, then 3, 4, 5, 6. Now in this order again we have to rearrange the securities. So this table will be from top rank to bottom. Why it has to be in the sequence, as because the in this formula as we can see this summation, so it is a cumulative summation, hence we have to keep it in the highest to lowest order. So once after plotting in the highest to lowest order, like A, which is the 5.33, and then 4.67, then 2.5, then 2, then 1.2, then finally 0.83. So this will be the order, and in this order only we have to keep. Then we have to start applying in this formula. So we'll just split it in different tables for easy understanding. First is the expected return minus risk-free return. The risk premium we are calculating here. 15 minus the risk-free return 7. So risk premium in all the cases 875,231, and then multiplying it by the beta and dividing it by the unsystematic risk. Now once we got this, we have to okay, here we got the portion of this formula. Then we have to take the cumulative of these values. So 0.3 in the next case, 0.35 plus 0.35 plus 0.3, 0.65, 0.50 plus 0.65, 1.15, like that till 1.66. Now we need to find out the denominator. Denominator is beta square divided by unsystematic risk. So beta square we know, and unsystematic risk also we have here. Dividing that will give this values. Even this values also has to be in cumulative formula. So once after applying in this cumulative formula, then CI we have to calculate like this. So applying in this formula, we have the market index variance as 10%. So 10% multiplied by the value, cumulative value which we got 0.3 divided by 1 plus 10 into 0.56 which we got will give us these values: 1.93, 2.814, 2.668, like this. Now out of these values, which is the highest one? So security F's cutoff value is the highest one, so this will be considered as the cutoff point. Now the third step, so once we got the cutoff point, highest is selected. In our case it is 2.814. okay, 2.814. Now this 2.814 we have to compare with all the trainers ratio which we earlier calculated 5.33, 4.67, all those. If we see 2.814 is the highest, so above this whatever trainers ratio we have to select only those, which is nothing but 5.33 in our case, and then 4.67. If we see others are not crossing the cutoff, so only security A and security F should be considered, that will be selected. Okay, once that is selected, then uh, we have to calculate the proportion to be invested. For that proportion we have this formula, right? So we'll be taking this. Same has been done here. Fine. Now okay, we already have all these values in the table, so from the table only we'll take it. Ri minus Rf, we have beta also we have, then unsystematic risk also we have, then cutoff point also we have. So we are getting a value of, for this proportion ZA is 0.09435, and in case of ZF it is 0.0928. Now totaling this two will give us the total number, then ZA divided by the total will give us the percentage, as they have done here. 0.09435 divided by that's 0.0943 plus 0.0928. If there are three stocks are there, then totaling those three stocks will be the denominator, and it will add up. If just only one return is there, we don't need this step only, we can directly take that security as the optimal one. Now since we got 50.41 and 49.51, 59 is the funds to be invested in security A and F. To achieve this optimal Sharpe's optimal portfolio. That's it. Thank you.